The American financial markets have just sent a powerful signal of renewed confidence, echoing across Wall Street and beyond. After months of uncertainty and volatility, the mood has shifted dramatically, with investors and analysts alike taking notice of the market's powerful rebound. In the week ending November 5, 2025, U.S. equity funds saw a massive $12.6 billion surge in investor capital, the largest weekly net purchase since early October. This remarkable influx of money marks a turning point, as investors pour back into stocks with renewed enthusiasm, signaling a collective belief that the worst may be behind us. This isn't a minor uptick, it's a decisive move back into the market after a period of correction. The sharp rebound in stock prices reflects a dramatic change in sentiment, as buyers step in to capitalize on lower valuations and the potential for future gains. Rather than panicking, investors saw the dip as a buying opportunity, doubling down on their belief in the long-term strength of American enterprise. This willingness to embrace risk, even in the face of recent volatility, highlights the resilience and optimism that define the U.S. investment landscape. This strategic buying during weakness signals a bullish sentiment and a bet on future growth. Investors are not just reacting to short-term news, they're positioning themselves for what they believe will be a sustained recovery and expansion. The sheer volume of inflows, billions in just days, shows a broad shift in investor psychology, away from caution and toward optimism. It's a sign that confidence is returning, and that many believe the market's fundamentals remain strong. The market is forward-looking, and this surge suggests many see a positive landscape ahead. Investors are weighing not just current conditions, but also the potential for innovation, earnings growth, and economic resilience in the months to come. Investors are betting on innovation, corporate strength, and the resilience of the U.S. economy. The technology sector in particular has become a focal point, with many seeing it as the engine that will drive future growth and prosperity. The numbers paint a picture of decisive action and renewed optimism. This is not just a technical bounce, it's a reflection of deep-seated confidence in the ability of American companies to adapt, innovate, and thrive. Understanding this trend is crucial for every investor, as it reflects a collective judgment about the economy's direction. The choices being made today will shape portfolios and strategies for months, if not years to come. When capital moves with such force, it can create its own momentum, potentially driving markets higher. This self-reinforcing cycle can attract even more investors, amplifying the rally and setting the stage for further gains. It's important to analyze where this money is flowing to understand the drivers behind this confidence. Are investors favoring growth stocks, value plays, or specific sectors like technology and healthcare? These choices reveal deeper trends shaping the market's future. The details reveal a story not just of general optimism, but of a specific bet on technology and American big business. These sectors are seen as the pillars of the next phase of economic expansion, drawing in capital from around the world. This is more than a rally, it's a strategic repositioning. Investors are rebalancing portfolios, shifting assets, and preparing for what they hope will be a period of sustained growth and opportunity. The investment community is signaling belief in the future of U.S. innovation. This confidence is not just about numbers on a screen, it's about the underlying strength and creativity of American businesses. The market's next moves will be shaped by how this capital is deployed. Strategic decisions made now will influence which companies and sectors lead the next wave of growth. We'll continue to unpack the story behind these numbers, exploring what's driving investor behavior and what it means for the broader economy. The stage is set for a new chapter in the market's evolution, one defined by renewed optimism, strategic investment, and the enduring spirit of American enterprise. The surge in equity fund inflows is capturing the attention of investors and analysts alike, signaling a renewed sense of confidence in the markets. This momentum is powered by growing excitement around artificial intelligence, which is rapidly transforming the business landscape. AI is now a real driver of business value, not just a futuristic concept. Companies are leveraging AI to streamline operations, boost productivity, and unlock new opportunities. Major companies are making bold strategic moves, deals, partnerships, and acquisitions centered on AI innovation and integration. Investors see these moves as clear pathways to greater efficiency, new revenue streams, and even industry-wide transformation, fueling optimism for the future. The narrative has shifted decisively from AI's potential to its real-world implementation, as companies showcase tangible results and measurable impact. The recent market correction gave investors a rare opportunity to buy into the AI revolution at more attractive valuations, sparking renewed interest and strategic positioning. Billions of dollars have flowed into companies leading the AI charge, making this a calculated investment based on research and conviction, not a blind rush. The focus is clear. The dawn of the AI era in corporate America is here, reshaping industries and redefining what's possible. Technology sectors, especially those embracing AI at their core, are reaping the rewards and setting new standards for growth. The market is rewarding companies aggressively pursuing AI, betting they'll deliver superior returns and shape the future of business for years to come. Of the $12.6 billion that flooded into U.S. equity funds in recent weeks, a staggering majority sought out the perceived safety of the market's largest players. Nearly $11.9 billion of that total was funneled directly into large-cap funds, highlighting a clear preference among investors for scale and security. Investors are favoring size, stability, and proven track records, placing their trust in blue-chip giants that have weathered countless market cycles. This is a strategic flight to quality, as large caps offer both resilience and the resources to lead in transformative areas like AI innovation and digital infrastructure. The preference for large caps signals a measured optimism. Investors want growth, but they're seeking it with a foundation of reliability and strong balance sheets. These companies are best positioned to capitalize on trends like AI, cloud computing, and automation, while also providing insulation from market volatility and economic shocks. The scale of inflows underscores conviction in these market leaders, as investors double down on the belief that these giants will continue to outperform. This trend is widening the gap between megacaps and the rest of the market, lifting overall averages and concentrating gains among the biggest names. For now, investors are backing America's most powerful corporations with overwhelming capital, betting on their ability to lead through uncertainty. Large caps are the undisputed stars of the rally, drawing attention and investment from around the globe. The market's message is clear: strength, scale, and innovation are what win in today's environment. Technology stands out as the main beneficiary of renewed investor enthusiasm. In just 1 week, tech-focused funds attracted $238 billion, their largest inflow in 5 weeks. This reflects the excitement around AI and the companies powering this innovation. Investors see tech as the engine of growth, especially after the recent correction provided a better entry point. The inflow is an active bet on tech's ability to deliver superior earnings through AI, cloud, and cybersecurity. Companies designing semiconductors, algorithms, and data centers are at the heart of this trend. Investors are positioning for the upside of this secular growth. Tech is once again the indispensable core of modern portfolios. The numbers confirm technology is the favored destination for growth capital. While tech basked in inflows, the financial sector saw the opposite. Financial sector funds experienced $1,027 billion in outflows as investors rotated capital into high-growth tech. This is a strategic reallocation, driven by AI's promise and financials headwinds, like interest rate concerns and regulatory uncertainty. Investors are making specific choices, favoring innovation over traditional sectors. The outflow from financials is a tangible sign of relative pessimism. This isn't a vote against banks' stability, but a chase for higher growth. The rally is concentrated in themes like AI, not lifting all boats. The numbers are clear. Tech is in, financials are out. Sector leadership is shifting as investors reposition for the future. Beyond large cap and tech, small cap funds saw a modest $114 million inflow. Small, but positive. This shows some investors are still seeking high growth potential among nimble companies. It's a sign of underlying market health and appetite for risk. In contrast, mid-cap funds lost $1.17 billion as investors shunned the middle ground. The market is polarized: safety and AI-driven growth in large caps, speculation in small caps. Mid-caps, lacking both stability and explosive growth, are being overlooked. The outflow signals investors believe the best opportunities are at the extremes. The middle is losing its appeal in today's market. While equities reshuffled, money market funds quietly made history. A record $118.05 billion poured into these safe havens in a single week, the highest in 11 months. This massive move reflects both caution and strategic planning. investors are holding large cash reserves, hedging against uncertainty and waiting for the right moment. This dry powder is a bullish long-term signal. It's ready to fuel future rallies if confidence grows. The cash pile is a powerful reservoir of demand. The record inflow shows the market's dual personality targeted risk-taking in AI, but high caution overall. Investors are playing offense and defense at once. This cash position will shape the market's next moves. Watch how and when it's deployed. In contrast to equities and cash, U.S. bond funds saw a slowdown, with $4.47 billion in net purchases, the weakest in 5 weeks. Investors are becoming more selective in fixed income, favoring high-quality, short to intermediate investment-grade funds. Municipal debt funds also attracted inflows, likely for tax advantages. The pattern is clear. Investors want yield, but with minimal risk. This defensive posture aligns with the broader theme of cautious optimism. Some capital is rotating from bonds to higher-growth equities. For those seeking safety, cash is now more appealing than broad bond allocations. The bond market is still attracting capital, but with less vigor. Synthesizing these capital flows reveals a market defined by both conviction and caution. Strong inflows into large-cap equities and tech show targeted optimism, especially around AI. But outflows from financials and mid-caps, plus record cash holdings, highlight selectivity and prudence. Investors are making deliberate theme-driven choices, not buying indiscriminately. The $118 billion in money market funds is the ultimate sign of caution and readiness. This cash could fuel future gains or serve as a buffer if volatility returns. The market is balancing offense and defense. The enthusiasm for AI and large-cap tech is real, but tempered by a slowdown in bonds and a flight to cash. Investors are betting on the future, but keeping their defenses strong. The next chapter will be shaped by whether optimism or caution wins out.